Today, folks, I'm sad to say that stupidity is getting the better of the market yet again, even though things are just exploding to the upside, which is not a pun because the stocks we're looking at are boring bank stocks that literally just popped 50%, but people are literally attacking the crap out of the Schwab US Dividend Equity ETF for clickbait. We're going to break this article down, talk about the financial sector that Schwab US, this dividend ETF has exposure to, because I personally have a lot of money in this ETF, and I want to make sure the management of this ETF is competent. The stock is underperforming the S&P 500 year to date. I mean, it's down about 6%. Year to date, the S&P has been absolutely crushing it. It's up 8.39%. Oh my God, taking the short-term perspective into our investing careers has always worked so well. But if we zoom out over 5 years, I think it's important to note that the S&P is only up 51%. You tap on the dividend, you're getting a little closer to 60%, but over the last 5 years, with that 3.5% dividend that the Schwab US Dividend Equity ETF has been paying, you're actually outperforming the S&P 500 still. It's starting to fall closely in line, but this has been one of the most world-renowned ETFs. I've kind of fallen in love with it. I've kind of started using it as a proponent to my US dividend stocks rather than just buying 20, 30, 40 individual dividend stocks, because it just holds my favorite companies. And we're going to get into this because this ETF from the Investor Observer says SCHD ETF stock home to toxic firms that could slash dividends. Ooh, baby, doesn't that send chills down your spine. So SCHD ETF stock is home to toxic firms that could slash dividends, and this was literally just released in a very bad day. That's the funny thing. It was released on a very bad day. I'll explain why in a second. To May 5th of all days, we'll talk. Let's get into this. The Schwab US Dividend Equity ETF stock crashed to investors. Yes, crashed. It's down like... It's down. Ooh, it's crashing, baby. We're down 6% year to date here. Getting into it, basically focused on bank collapses and moderately hawkish statements by the Federal Reserve. The SCHD stock price dropped to as low as $69.40, the lowest point since March 17th. In all, the fund has fallen by more than 10% from the year-to-date high, meaning it is now in correction zone. I mean, from year to date, we're down, 7.45% from that year-to-date high. It never really peaked below that 10% unless you're taking it from the all-time high. Then it maybe hit the 10% lows. So this article is really drawing at straws here. You know what I'm saying? Like, really pushing to be like, oh, we hate these guys. We hate these guys. Getting into it, though, the main theme is in the financial market this week, where the collapse of regional banks and the relatively hawkish Fed statement, these events had direct impacts on SCHD, which is one of the best known ETFs in the world. They're like, yeah, we know it's the best. We know we're going to get clickbait. Let's go, baby. For example, the collapse of First Republic Bank on Monday led to the fears of the contagion in the banking sector. As I wrote in this article on Monday, there are concerns that other banks like Comerico, Zions, Western Alliance, and PacWest could collapse as well. As a result, the KRE ETF has fallen by over 14% in the past 5 days, and the collapse of these banks has impacts on SCHD stock since it has stake in several regional banks. It has smaller stakes in banks like M&T Bank, Regions Finance, Zions, Cathay General Bank Shares, Northwest, OFG, Comerico, Premier Financial, and Synovus Financial. Comerico and Zions are some of the top banks at risk and could go out of business soon. Those regional banks that remain will likely be forced to lower their dividends. Dun, dun, dun. So let's break this down. Let's talk about a few of the banks in here. Let's see where they currently sit today, why this ETF or that article was written at such a horrible time. So I love SCHD, the incredibly low expense ratio, the wonderful dividend yield that it pays out. It's just a beautiful ETF. I mean, the 30-day yield here is between 3.7%, 3.61%. It's wonderful, right? So if we actually take a look at the exposure rating first, because the top holdings are of my favorite companies in the U.S. PepsiCo, Merck & Company, Coca-Cola, Verizon, AbbVie, Home Depot. These are some, Pfizer are just really well-renowned companies. And if we break it down by sector, industrials make up the largest percentage, right? So nothing to do with banks. Healthcare, second largest percentage, nothing to do with banks. And then we go 14%. A measly 14% is made up by financials next to consumer staples. And keep in mind, even though 14% is financials, it's much more diversified because financials do not sit anywhere within the top holdings. So let's just kind of go into the view all holdings tab here, and let's click control find, and let's look for something like the Zion one, right? So there's Zion Bancorp, which makes up a measly 0.1%. But let's talk about the damage this could have. There are some other ones in here, and I've kind of skimmed through a bunch of them, like Bank of Hawaii Corp. There's a few in here, right? But they're so minuscule. And I know that I think there's US Bancorp in here as well, which is something that Berkshire Hathaway did remove. So let's just see, is US Bancorp in here? I thought it was. I think it is. It says it's on here. There it is. So you got US Bancorp in here as well. Maybe we'll take a look at that one because it's probably one of the larger holdings at 1.28%. But let's start off with Zion's, right? Like, taking a look at this company, it is up a whopping 19% today, the same day this article came out. I wonder why that is. I mean, you take a look at the stock and it's just been getting absolutely clobbered. I mean, we're talking about catastrophes as big as the 2008 financial crisis in these kind of stocks, right? But let's just take a look at the financials real quick before we talk about why it's popping so aggressively today. I mean, first and foremost, the last reports were pretty reasonable, and this is all in relation to bank runs, right? But if we take a look at the statistics first and foremost, this is a company that's likely to cut its dividend unless there's a huge bank run. Well, the payout ratio is 27% as of the last filings, right? Financials, we're talking about a company that's actually been growing pretty reasonably here. Let's take a look at US Bancorp just to put it in perspective. Like, what's the odds of this bank, cutting its dividend? Well, its payout's a little higher, 50.8%, but still, obviously, that's in line. That's pretty renowned, right? We're talking about a company, that is growing from 2019, from 22 billion to 24 billion in revenue. We scroll down and we take a look at the earnings here. They have been beating a lot of the analyst estimates quarter over quarter. It looks pretty reasonable. Their last quarterly was really great, 6.7 billion in revenue. I mean, let's take a look at the cash flow here. And obviously bank runs, issues, debt. There could be a lot of issues. The free cash flow here has been a growth beast. I mean, from 4.8 to 21 billion in free cash flow. Like, these numbers are pretty resilient. Let's pull up the Western Alliance. I don't think SCHD holds, but this is one that we're going to discuss in a moment because the Western Alliance Bank also, it looks like 2008 all over again here. Like, this is a pretty miserable crash. But if we take a look at the last day, the stock's up a whopping 44%. I wonder why that is for failing banks that are going to be cutting their dividends. Why are they popping so aggressively? Are people just risk adverse? Do they just want to throw all their money into these collapsing banks because they think it's just going to be a bailouts and stuff like that? No, it has nothing to do with that. It comes out of the biggest bank basically in the freaking planet. This is going to blow your mind. From literally the largest bank in the US, literally pretty much one of the largest banks on the freaking planet, says Zion's and Western Alliance's stocks soar after JP Morgan says buy because they are substantially mispriced. What? The same day this article was released, May 5th, the same day this clickbaity article came out. And just reading into it, the other reasons why SCHD ETF is at risk is its stake in Paramount Global. Paramount stock price dived by more than 25% on Thursday after the company slashed its dividend. Now, this is believable. Paramount, let's just take a quick look at the holding here. If we kind of backtrack, we look up Paramount. Where do we got it in here? Let's see if we can find it real quick. Paramount Holdings is what we're looking for, making up a whopping 0.27% of this entire ETF. So Paramount, is it going to be that substantial of an impact on this company? Not really. This is why we diversify a portfolio. I mean, this guy's talking about it like, these individual stocks are going to ruin the dividend of SCHD or something. This is an important part of SCHD since the ETF is usually bought because of its dividends. Oh my God, the minuscule amount of bank exposure and, the tiny little 1 point percentage that it has in this Paramount company are going to ruin it. But further, SCHD owns Chevron and Valero Energy, which are expected to have lower returns as oil and gas prices crash. Now, that's obviously something that I could believe in, right? I honestly think oil and gas, that could potentially have an impact on SCHD. And if we take a look at the oil and gas holdings, again, just kind of taking into consideration here, let's take a look here. How big is energy? 9.27%. So some of the biggest risks here are going to be energy and financials, right? So financials at 14%, energy. So, about 25%, a little less than 25%, there's going to be a little bit of exposed risk there, as there is in every ETF, as there is in the S&P 500 with ExxonMobil sitting at the top, 10 largest companies in the US right now, as there is in my Canadian counterpart ETFs. There's going to be risk in the price of oil. But is oil going anywhere anytime soon? Well, probably not. And even if it does, you don't think management's going to, reweight some of these companies out. And, I like having a bit of energy exposure because typically during rocky moments in the market, even though oil's still sitting up pretty decently, they're still going to make revenue. They're still going to be able to afford probably a lot of the dividends. Is Chevron broke? Should we look that up? Should I be worried that Chevron's going broke in a market environment like this? Are they going to cut the dividend? Well, how tight can it be? I'm not a genius here. I'm not going to get too into this. One of you guys can monkey around and do the research and tell me, if Chevron's going to bust here and completely cut this 3.77% dividend. What's their current payout? Let's just dive into this. This heavily, like I said, I'm being a little critical of this heavily negative article when their payout ratio is 31.16%, but it's like they're enticing people to not diversify and buy a super stable dividend ETF. I mean, you could buy this, you could buy VYM, you can do whatever makes you comfortable, but it's just funny to me. It's like, it's so ironic to make an article like this the same day these bank stocks explode because JP Morgan says the exact opposite. I don't know. It's funny, guys. Well, happy Friday. I hope you enjoy your weekend. I hope I made it a little bit better.